Good morning, everyone, and welcome back to the latest series of Retirement Plan Academy with the Trust Company of Tennessee. I'm Zach Hurst in our Chattanooga office, joined by Adam Davies, who heads up our retirement plan services, and Miranda Carr, our Chief Investment Officer. We have a lot of good topics to cover today regarding an investment process and a lot of topics around investments that we're all hearing or maybe even fearing in some cases. And touch on some of those. It's certainly questions that probably a lot of you being plan sponsors, are naturally getting from your own employees. And so hopefully we can provide some insight as to how we're guiding people and how we're advising. And we certainly want to, obviously, we know there's a lot of conflict that arose overnight between Russia and Ukraine, and that's going to continue throughout the days ahead and potentially weeks ahead. So we're monitoring that very closely. We've got some points on that we're going to get to throughout this. Of course, there's no crystal ball. We can't say what's going to happen or what's going to come of this, but we can certainly talk about strategies around times of global conflict like we're experiencing right now. But first and foremost, thoughts are with those in Ukraine and then what's going on there, and that's the most important thing. So with that, we would like to jump into a couple of things that we need to cover before we get into the materials. And the first is you're going to see somewhere on your panel, I think my screen looks different than yours, but somewhere on the panel, you're going to see a questions box. And in there, you're able to type in a question as we go. Please feel free to do it as questions come to mind. If you already have questions coming into this, please go ahead and input those now. And what we'll do is between Adam and Miranda, we will cover those hopefully as we go and cover those on the slides that we're looking at. If we don't, or if we miss it, then we'll certainly leave time at the end to take care of those. We are offering CE credit here. We have 1 hour of credit for HRCI, 1 hour of credit for SHRM, which we'll get to you after the broadcast today. It'll probably be no later than early next week for that. And we also offer CPE credit. There are a few requirements I have to list for this. I'm going to use my cheat sheet as I always do for this. But we do have 3 poll questions throughout this webinar. And for those who are here for CPE credit, and please all of you as well, answer those. You'll need to for CPE credit. Reminder to stay for at least 50 minutes. I don't think we're going to keep you very long past that. And we also have an evaluation form upon exit that you'll need to complete so that we can get you the document you need for the credit there. So with that, I've introduced us a little bit, but talk a little bit about the Trust Company of Tennessee. We are a financial planning firm that covers most of East Tennessee and also have clients around the country. We focus pretty heavily with the group we have here today, and that's retirement plan services, be it 401ks, 403bs, or whatever else it might be. So the purpose of this is for us to be a resource and talk through some things that we really focus on. And even if you're not a client, totally fine. I'm sure you've got good providers, and just make sure that the communication that you're getting from them is what you need, especially during heightened times like this. So Adam and Miranda, I think I've covered enough about us, and I think we want to jump into our first of 2 sections. This is going to be investment themes. Again, we're going to really focus on some topics that we're hearing all over the news right now. Again, yes, we'll include the Russia-Ukraine, but we're also talking about rate hikes and inflation and things that have really been out there for a few months now. So Miranda, with that, we've got a few topics here on the first slide, economic review, if you want to take us through these.
Sure. Thanks, Zach. So I just want to start with looking at our economic growth numbers, because despite what's going on in the markets right now, due to the headline risk that we're seeing, we are in the middle of a really strong recovery. And so we did experience a contraction during the pandemic. You can see on that left chart that across the world, global growth was negative in 2020, followed by a really sharp rebound in 2021 across the world, and then expected to have a strong rebound again this year. So really strong economy. Companies are able to do really well right now. In fact, we are getting earnings from the fourth quarter for the S&P 500, and companies have been growing earnings at 30%, which is just an astounding rate of growth for company earnings. So strong market, strong economy, and we'll talk about some of the underpinnings of that. But the labor market is the strongest we've seen in 50 years. Job openings are at a 20-year high. Employment levels, so the total number of people employed, are still below pre-pandemic levels, and we'll dig more into that in a few minutes. But the supply demand for labor certainly helps the consumer with wage growth, and it also leads to inflation. Some of that is coming down, though. You can see the bottom right chart shows shipping costs. This is an index that basically it's just saying things got really tight. We all felt that really acute supply demand imbalance as we're all staying home buying more stuff. And so the inflation got hotter than we've seen in a long time, but it's starting to come down. So you can see this chart is just showing that some of that pressure is beginning to alleviate.
And on inflation, typically we try to get the answers from audience on these poll questions beforehand. We took a different approach this time. We're actually going to test your knowledge of what was just said. So behind the scenes, we have somebody who will launch a poll question regarding inflation in just a second. And so those who are on the webinar, please answer, and let's see if you've read the charts correctly and heard Miranda correctly. And we'll give that 1 second to launch. Here it comes. And Adam and Miranda, are you able to see that on your screen?
I sure can.
Great. And I believe it's locked on my screen, but I believe the question is what is the current rate of inflation? Is it 2.5%, 5%, or 7.5%? Is that accurate as to what you see on the screen?
That's what I see. Zach, any guesses?
So I stopped and filled up on gas this morning, and it feels like 7.5% based on that, but I'm going purely off of my own experience today. But we'll give a second for the viewers to chime in here. And Adam, are you able to see the results on that one?
I can. So 61% got it right. 7.5% is the current rate of inflation. So very astute audience.
That's right. And how far are we? Perhaps this was covered as I was looking into that, but from this time last year, possibly 2 years ago, how much higher are we, Miranda, versus where we were a year or two ago?
So that's a good question, and there are lots of different metrics for this. Some metrics are 2-year inflation or even a 3-year inflation. I don't have the exact numbers, but we did have price drops in 2020. And so initially in 2021, we saw what we call the base effect. So basically, we had a higher price level than during the recession, which typically always happens. So you get an initial higher reading. And that's what was causing a lot of economists to think that this was a bit transitory, that some of these base effects were playing into it. We're now well into the recovery, and so it's becoming apparent that base effects have less and less impact on the inflation number. So it's running at, I think it's safe to say, hotter than 7.5% over the past 2 years.
Got it. And those numbers that we're looking at right there, you get the headline CPI and the core, CPI and the core CPI. And so we're really talking about the headline is what I feel, the consumer, right? That's factoring in anything from my shopping to my gas to things like that, correct?
Correct. And if you want to bring the slide back up on the screen.
Oh yeah, that's right. I didn't realize I was off. Yeah.
Yeah, the headline is basically the whole index. So the inflation price index. Core strips out food and energy because food and energy prices are commodities that move around a lot. And so core really looks at, if we take out the most volatile pieces of inflation, what does that look like? And that's still quite high. At the end of, I believe this was a November number, it was about 5%.
Got it. And sorry for the technical trouble. Are we back live? Can you guys see the screen again?
We are.
Perfect. Great. Adam, we talked a little bit about GDP on the lead into this call, and I think you had a couple of points on that you wanted to cover on this as well.
Yeah, so definitely a change from what we'd seen the last 10 years. I remember talking to clients about how GDP had been pretty stubbornly 2% or below for the last decade. Really nice to see it as high as it was last year, and it looks like forecasts are expected to be above that 2% going forward. Miranda, any thoughts on what's driving any of that?
Yeah, so I think that the encouraging piece is that 2022 is expected to be, above 4% for the entire world, because in 2021, a lot of that change was a recovery from the negative growth we saw in 2020. So a higher growth coming off that, but most of that is driven by stimulus, right? So we've had fiscal stimulus, we've had monetary stimulus, a lot of liquidity in the system. People have been buying a lot of things while they stay home. That's driving up demand. And so I think a lot of this has been government spending around the world, and also easy credit conditions. And so during the recession, when the Fed lowered interest rates to zero, to emergency levels, basically, that did stimulate demand, right, for credit. And so that has definitely had an impact. And so I think in the face of Fed tightening, as interest rates are expected to rise, we'll see what the economic growth ends up being, but it is encouraging that we're still looking for pretty healthy growth rates, and which makes us think that the economy can support higher levels of interest rates. So a lot of people are nervous about the Fed raising rates, but the reality is we're at emergency levels right now, and we have a very strong economy. So as the Fed does raise rates, we likely can withstand some higher levels and try to choke off inflation a bit.
And it's interesting. I was having a conversation with a client the other day, and we were talking about how if the Fed increases interest rates, it's going to make purchasing a home more expensive. It's going to make purchasing a car more expensive. And he mentioned, he's like, but we have shortages on both of those. Like, it's hard to find trucks. It's hard to find cars, hard to find houses. And so I think that makes a lot of sense as well, and that it might not necessarily slow down the economy like it might have in other situations previous years.
That's right.
And I know we're going to touch on all of these topics here shortly. One being the U.S. labor market that you see in the top right of the screen. We realize that a lot of these plan sponsors on the call are also in the HR space and dealing with just job battles. And so we're going to cover a little bit about that and probably something that's a front of mind and a big focus for the people on this call. So more to come there, but let's start with the hottest topic and continue with that, which is inflation, and just some numbers here, Miranda, that you wanted to cover.
Right. So, well, you might not have guessed 7.5%, which was the most recent print for inflation. You probably did notice that your bills are going up at the grocery store, at the gas station, food and energy, up a lot more than we've seen in a number of decades. And so, gasoline up 58%, as we're all moving around a little bit more than we did in 2020. We're flying, we're driving, we're using up gasoline. At the same time, OPEC, which controls a lot of the world's oil supply, has not actually increased the supply. So they've enjoyed the higher prices of oil. And so what we have is demand going up quite precipitously, but supply not coming online quite as quickly. And as we look at the situation in Russia and Ukraine, I think what makes this a little bit different than some of the geopolitical crises we've seen is that Russia accounts for a lot of the world's commodities. So especially when we think about Europe. So Russia supplies 12% of the world's oil, 17% of the world's natural gas. It's responsible for a large share of things like wheat and palladium and other commodity prices. So I think long term, this impact probably it's not a huge impact on the economy, but short term, I think the biggest impact is going to be inflation. We're already seeing inflation, and I think just to constrain the supply even further is going to drive up the numbers in the short term, which could cause the Fed to have to act a little bit differently in a few weeks when they meet. So I think near term, what we're watching most closely is the impact on inflation from this conflict.
Yeah, that's pretty interesting. And talking about inflation, Adam oversees our retirement plan services, and we spend a lot of time with our plan sponsors during times like these and with participants as we go out and advise on plans. And Adam, the question I've gotten a lot, I'm sure you have too, from participants in plans is, okay, so inflation's high, right? And it seems like that's going to be sustained at some level for the foreseeable future, and especially now with the rising conflict in the East. So Adam, is there a certain direction that we advise people towards during times like these? What's really, as you're talking to participants in plans and these plan sponsors, what's an approach we like to take?
Oh, definitely. And I've gotten that question more in the last 2-3 months than I have in the last decade. And so it's on a lot of people's minds, and they want to know, how should I be invested to make sure that I don't lose purchasing power or my account keeps up with inflation? And so generally, we recommend people go into stocks, growth assets. And so, for example, our growth portfolio are very diversified. There's large cap, there's small cap, U.S., international, real assets. Real assets in particular do very well during inflationary periods. Our real estate fund was up 40% last year, and so that definitely added a lot of return to our growth portfolio. And so, we talked about the overall rate of inflation was 7.5%. Our RPS growth portfolio returned about 19% last year, and so even stripping away 7.5% inflation, you're still net 12% ahead, even considering those effects of inflation. So while that is, companies, stocks are often able to pass those costs on to consumers. And I was reading an article the other day saying that a lot of companies are viewing this inflation as a once in a decade opportunity to increase prices, because with inflation being 2% or below for so long, they haven't been able to increase those prices, for the last 5 or 10 years. And so now the consumers are picking up the newspaper every day and seeing inflation. They're saying, hey, this is our opportunity to pass along some of those costs to customers, increase those prices, many of which you guys might have felt when you're at the grocery store or at the gas tank. And so generally we recommend stocks because they do very well during inflationary periods.
Yeah, and I think for plan sponsors, the big takeaway here is just having a process in place and having that communication in place, because we're all human, right? And we have emotions that come around times like these, and heightened times around the globe, and it's how do we protect our money best, and do we have the best approach? And I think just being a sounding board for them, right, is the most important, and talking through what's important to them, and understanding their overall risk strategy. But I had a call this morning with a client, and he said, I really wish I had money on the sidelines to invest right now, right? It was sort of his message. And I thought about 401k plans, right? And not saying that right now is the right time to buy in, who knows, but it's certainly at some kind of a discount over the long run. And I thought about 401k plans and what an advantage that we're all in for those of us who have them, to where we're naturally buying into these dips every 2 weeks or month or whatever amount of money we're putting in towards those. And so I think it's a good message too, to remind people that they're actually taking advantage of down markets just by doing the organic strategy they have in place. Miranda, consumer finances, this is pretty interesting. And Adam, I think I might ask you to make a comparison from now to 2008 at some point on this as well. But Miranda, walk us through this slide if you don't mind.
Sure. So there are two big themes that we think are underpinning the economy that are reasons for optimism. And the first is consumer finances. And so consumers are actually in a really healthy shape right now. They've got a lot of assets, home prices have been going up, the markets have been going up. And at the same time, interest rates have been quite low. So the debt payments are pretty manageable. So right now, debt payments as a percentage of personal income are at a 40-year low. And part of that is low interest rates, but part of that is also that personal income actually went up during the pandemic. So due to wages rising, but also the stimulus checks and payments that went out, personal income went up at the same time that interest rates are falling. So that just means that there's more money for consumers to spend on things, which will benefit companies, which will benefit the stock market. So that's one of the main themes that we think is really sustaining this economy and is going to continue through 2022.
And Adam, earlier on in our sort of prep for this, we talked a little bit about 2008 and sort of these scarier times that have happened throughout history. And you made a point that this really looks nothing like 2008, I believe. Do you want to elaborate on that?
Sure. So, anytime there's a market decline, whether that was 2015, 2018, COVID, the brief decline we had last fall, one of the questions I always get is this another 2008? And so as you look at data like this, I think it really, paints that this is a different picture. So if you go back to that top right chart, household debt service ratio, back in 2007, 2008, I mean, consumers were very leveraged. You can see how high their debt service ratio was, 13%. You fast forward 10 plus years here in 2021, 2022, I mean, they're in a much different spot. They have much less debt. If you look at the bottom right chart, household net worth, it's consistently gone up over the last decade. So consumers are in a very different spot. And so I feel like declines that we've had lately are very, very different than 2008, occurring for different reasons, whether that's headline risk, Russia invading Ukraine, or, pandemics like COVID. So I think looking at data like this can really help reinforce that, 2008 was a very different scenario than what we're experiencing now.
Yep. And the next slide is going to cover labor demand, job openings, and things like that. We are not going to give you the cheat sheet this time. We're going to hit you with a poll question first to see if we can get that right, and then we'll cover it. And so, Joanna, behind the scenes, if you could launch our next poll question. And again, those who joined us a little bit late from the audience, this is a requirement for some of the CE credit that's out there. So Please take time and answer this. This question being, how many job openings were there at the end of 2021? Was it 3 million, 11 million, or 23 million? Miranda, I think you know the answer to this one. Adam?
Boy, all three seem pretty high. 3 million, 11 million, 23 million. But if you think of an economy as big as the U.S., something like 3 million might not be as high.
That's right. That's right. And I think talking to a lot of the plan sponsors who, again, are oftentimes in the HR space, talking with them about this, it certainly seems like it's a high number because everybody's trying to find talent and bring people in and fill positions. And it just seems like a global problem right now across many industries. And we will get the results. And there you have it. You've got the most votes with $11 million there. Miranda, you want to give us the right answer?
I will. And I do want to start by saying this labor market is not 2008 because there are 11 million job openings right now. So if you go to the labor demand slide, we can see in 2008 what that looked like. So job openings on the left side dropped pretty sharply. There are about 2 million job openings. And the most recent survey we saw for this statistic was still close to 11 million. And just for context, we have about 6 million unemployed people in the US right now and 11 million job openings. So certainly a gap there. And some people ask, well, why are 6 million people still unemployed if there are 11 million job openings? And some of this is a skills mismatch. Maybe we have a lot of construction job openings, but we have a lot of teachers looking for jobs. Some of this is regional. So there is a little bit of a mismatch, but still a huge gap in the demand for labor versus the current supply. And so one of the questions we get is, where are all the workers? Why is the job market so tight? Because it is the tightest labor market we've seen in 50 years. And there are a lot of reasons for this. It's not really a simple answer. I know last year there were a lot of generous unemployment benefits, and so everyone was kind of expecting once those started to roll off, we'd get more people back in the labor force. And to some extent that happened, but not really, not to the extent that we were expecting. And part of this is that the labor market looks a little bit different. So the Economist estimates that we've lost between 1.1 and 1.3 million people due to COVID. So these are the excess deaths. If you want to look into that, they've got all of the information on their model on their website. But that's a big chunk of the labor force that's not with us anymore. We also have long COVID where people are on disability. So the pandemic did have an economic impact, specifically when we think about the labor market. There are additionally 1 million people who are not looking for a job, and the reason they cite is the pandemic has prohibited them from looking. So maybe they're immunocompromised, or maybe they're just worried. They don't want to go back out right now. We also have schools which are in and out, so that causes some parents to not be able to look for work right now. We also have had a really nice recovery in the stock market and in home prices, and so a lot of people have been able to retire early. And so right now there are 2 million fewer workers in the 55 and above age group than there were pre-pandemic. We also have 2 million fewer working age immigrants than we did pre-pandemic. So you can see that's millions and millions of people not in the labor force, not looking for a job, that may have been looking for that may have been counted a few years ago. So quit rates are up. You all may have been experiencing this in your business where people are getting offers very easily. They're finding jobs, and so they're able to quit their current job. And layoffs, of course, are down because we want to keep all the workers we can get right now. So really tight labor market that has put upward pressure on wages. You've probably also noticed this in your businesses. Wage inflation is the highest it's been in decades. So a lot more power, I guess, with people looking for a job. But there is a little bit of light at the end of the tunnel. So economists are looking for that prime age working group, so people between the age of 25 and 55. They expect that that group, the size of that group will be what it was before the pandemic by the end of the year. So expecting some lessening of pressure on wage inflation and the supply-demand imbalance here.
Well, as 3 young parents on the screen here, I hope that that's a product of schools being back to normal, or daycare, or nannies, or whatever it is, because that's been a bear for a couple of years. I can relate to those people.
And Miranda, I like how you summarized that, because I know when I'm talking with clients, a lot of times they're looking for one single answer as to, why there's not enough people to fill all the positions. But I think it's really a combination, like you said, whether that's, on the morbid end, people dying due to COVID, or, on the more benign end, people taking care of family or children, or choosing to retire early. There's really a multitude of factors that are leading to this impact.
Yep. And Adam, I feel like talking about labor demand and sort of some things that go with that, I feel like every time I've talked to you in the last 6 months, you're talking to some company about a startup plan, right? Some company who's saying, we need to institute this, or we want to, whatever it might be, but it seems like it's almost a need now to have a retirement plan in place to keep up with the competitiveness. I mean, is that fair to say based on what you've experienced?
Oh, certainly. Just in the last 2 months, we've probably had a dozen companies reach out to us saying they need a 401k plan so that they can remain competitive. If you think about all these people, great resignation, quitting, looking at other opportunities, employers are looking at every tool they can utilize to recruit. 401k could be a big part of that. So, if an employee is looking at your company and someone else who may have a 401k, perhaps your company doesn't, that could be the deciding factor when looking at the two opportunities, all else equal. And so for those of you on the call that already have a 401k plan, really make sure that you reinforce the benefit, communicate that to your employees, because it is a great tool for retention purposes in today's labor market.
And I would add that's not just anecdotal. That's actually being measured by the Bureau of Labor, that companies across the board have been increasing their benefits by almost as much as they've been increasing wages. So about 4% increase in benefits, whether that's a match or health insurance or other benefits. And on some of the surveys that the Department of Labor or the Bureau of Labor is doing, companies are making choices based on the benefit package and not just the pure comp. So definitely something to keep in mind.
Yeah, good info. And I talked to somebody recently who's actually reviewing their current plan. It currently provides a 1-year waiting period before they can enter into the plan, and they're saying we're just not sure if that's going to work anymore, right? Because now they're getting feedback from people coming in saying, well, I'm leaving a great retirement plan set up, so I'm not comfortable just stalling for a year. And so even if you have a plan, it's a good time to kind of review what you have in place and whether or not that might be the right thing for how you're trying to recruit. So with that, let's move to section 2 and the last section, which is our investment process and outlook. We're going to talk about how this is sort of defined and the approach that we take. And we also want some of your clients, so we want you to understand what this is in the case that, or in the event that you don't already know. But some of you aren't clients, some of you already have good plans with other providers, but it's a good chance for you to sort of understand what this should look like or what it could look like, and certainly go to your advisors to understand what it does look like so that you're covered and you can educatedly speak to your employees about this. So Miranda, we are going to talk through our investment process first, and we'll go from there.
Great. So our investment process is a really disciplined process based on our philosophy of long-term investing principles, diversification, active and passive managers. And so everything we do really reflects that core philosophy. And so we do have a research consultant that we use. They've got over 40 full-time research analysts that we definitely leverage. And we develop long-term capital market assumptions. So these are 10-year forecasts for things like risk and return, that also we're looking at inflation and valuation, and lots of different metrics go into this to inform our view on what the next 10 years will likely look like for each asset class. And so our philosophy is really long-term. It's not really thinking about trading in and out of the market or trying to time things based on even big events like what's going on in Russia and Ukraine. It's really thinking about over very long periods of time, what do different asset classes return and what is their risk and where are we in the cycle? And so that's the really important part, because we do focus on asset allocation. We're thinking about large cap versus small cap, and we're thinking about emerging markets versus developed international markets. So we're creating those model portfolios that are reflecting that asset allocation based on the long-term views. And then we think about how to actually execute on that. So do we want all passive exposure or active exposure? And that just means, do we want to track an index, or do we want to pay a manager to pick stocks? And we like to do both. There's a lot of research on this that shows that it's really hard to outperform in certain asset classes. And so in those cases, we say, we don't want to pay a manager to try to do that because we know it's difficult to do that. So let's just get exposure to the index in a really low cost way. And then in places like emerging markets, where there's a lot of variability between what managers can do versus the index, there's just so many choices. There's regions and sectors and countries and companies. And so that's an area where it does make sense. And so we do spend a lot of time finding really good managers that have a grip on what's going on in those asset classes and put them in the portfolio and then monitor them. And then we look at pairing growth and fixed income based on each investor's risk tolerance, when they plan to retire, or what their other financial goals are. And then we monitor and update as needed. So we are watching our managers, making sure that they're following their investment process. We're looking at our portfolios to make sure that they're reflective of what we think our views will be. And then we make those changes typically once a year.
What are, just for the audience sake, just, I guess, generally speaking, what's the difference between a developed market, international developed market, and emerging market?
Sure. So developed markets are markets where they've had longstanding financial systems in place. So you think about places like Europe, the UK, Germany, those are developed markets. Emerging markets are places you would think of that have emerging international emerging financial systems. So like India, China, some countries in Africa would be considered emerging. So yeah, the difference between those technically is kind of where their financial systems are, but also if we think about the parts of the world that have the most potential for growth, those are the emerging markets, right? Because their markets are still really nascent, and so there's a lot of room for growth in the middle class. There's a lot of room for developments in their infrastructure and in their financial systems, and so there's a great opportunity. There is a lot of risk in these markets, as you can imagine, but there's also a lot of potential there.
And
Yeah,
Miranda,
go ahead, Adam.
go ahead, Zach.
No, please fire away.
Well, I was just gonna say, as I was looking through this, we might have some plan sponsors on the call that, picked an investment lineup or worked with a consultant to pick an investment lineup. But I think that last point, monitor portfolios and evaluate the performance, is really important. So you could have picked a fund that has performed very well in the past. You have the highest conviction that it'll do well in the future. And then, like anything in life, things change. So Miranda, what are some things that we look at that might consider us to make a change in a fund that, maybe 2-3 years ago was a great fund, but something has changed along the lines?
So I think most people would probably think performance, and while that is one metric, it's not the main metric. Typically, really good managers have a bad year. And so if a manager has a bad year, that's not necessarily a reason for us to fire them. I think the big things that we look at are investment process. Are they following their process? Some funds just get too big, especially in some of these markets that are smaller, that it's hard for them to continue to follow the process because of their size. And so in the past, we have terminated managers because of what's called asset bloat. They've gotten too big and they're not following their process. And so that fund is not doing what we want it to do in our portfolio. Another reason would be if a really important person leaves, if they're the head portfolio manager, and that's not always a reason to terminate a fund, but if there's a lot of conviction in one of the people running it and they leave, I think that's a reason to look at it as well. And then persistent underperformance obviously would cause us to take a look at what's going on, see what happened with the investment process, and see what's going on there, or even just a change in the environment, right? So we moved into REITs a number of years ago, not because of the manager that we were using on the real asset side was different, but just because we were expecting something different in the economy. So sometimes a lot of times it is the manager, but sometimes it's just our outlook on asset allocation.
And I think what we've experienced on our side, Miranda, is through active management and really preferring that on both the international and the emerging markets side is like we're experiencing right now, right, with Russia and Ukraine, and Russia typically being one of the bigger players in that emerging market space. I think we have very minimal to almost no exposure there right now because of active management. Is that accurate?
That's true. So Russia does make up, part of the indices for sometimes developed Europe and sometimes emerging markets. But we do have active managers in our international space that if they sense a risk, they can pull back. And so you're right. I think our growth portfolio now has about a 1% exposure to Russia. And active managers that have boots on the ground that are paying attention to local situations are in the best position to make changes based on what's going on, and even look at if there's an opportunity in the future based on what's going on.
Yep. Yeah, for the plan sponsors on the call, again, that's just having that relationship between the advisor and your participants, and just making sure that those who are concerned have information like that, right, that they can share and let them know that they're a little bit at ease and they're not so subjected to what's going on there right now. So just one little tidbit, and then we will move into the 10-year outlook that you mentioned, I think, a couple slides ago, Miranda, and if you want to take us through this.
Sure. So I won't get too granular here, but this is something that we update at least once a year when things are a little more volatile. We take a look at it more often, but these are really long-term forecasts. And each year we update our outlook. This is showing the expected return and the change from 2022 over 2021. So what you'll notice here is that nearly all asset classes, the expected return actually went up in 2022 after a really nice 2021. So we had really great performance in 2021, and yet we're still expecting higher returns for these asset classes going forward. And the big reason for that is inflation. And so when we think about return, we're thinking about that on a nominal basis, which includes inflation. So adjusted for inflation, this is not as attractive as you might think. But because of inflation, it is an input. All asset classes return expectations actually went up this year.
And is there, I'm looking at the percentages, I'm looking at the far side of this chart, year over year change, and a lot of these, almost all of them are under 1%. Is that normal, Miranda? I mean, do we see big changes year over year, or is this about what we see?
This is pretty typical year over year. So we're just kind of inching it 1 year rolling, 10-year forward expectations. And so if you think about what this means for portfolios, it means that the changes in the portfolio aren't super dramatic, which is really what you want. You don't want to be moving your portfolio around really significantly year to year. I think when we see changes in interest rates, that could impact things a little more quickly. But the fact that almost all asset classes went up last year means that they're all related, right? So if things are more if something goes down and something goes up, you might see a bigger change. You might see close to a 1% change, but since almost everything went up, they all kind of went up together. The exception there is emerging market equity. And so you can see that the increase there for the expected return is a bit above 1%. So that's the asset class that we are expecting to have the highest expected return over the next 10 years because it had a negative return in 2021 while the rest of the world was up. However, as I mentioned before, emerging market equities also have one of the higher risk levels. So we're not actually making all of our allocation decisions just based on return. We're also thinking about the risk. And so a good example of this is small caps. Small caps have a higher expected return than large caps. However, they have a much higher risk. And so we actually trimmed from small caps. We'll get to that in a second. But this informs our allocation, but it's not just return expectations. It's really important to think about the risk and what can go wrong in the portfolio and make sure that we are managing that appropriately.
And Adam, I'm going to put you on the spot here, and hopefully you'll have a quick answer for this. But as we look through this asset class lineup here on the chart, thinking about 401k plans or retirement plans, are there additional asset classes that we typically see in those plans, or is this even more than we typically see?
Yeah, so this is a pretty representative example of what we see in 401k plans. There are some extra categories that we typically don't include in retirement plans, mostly because of the volatility perspective. You could think broad real assets, commodities, things like that, dynamic bonds. Those are things that, if you think about an investment lineup, participants have the opportunity to go 100% into anything that is included in that lineup. And so we'll talk a little bit later about kind of our philosophy, how we create those lineups, but we want sufficient diversification and we want to build in those guardrails so participants can't go astray.
Gotcha. Well, we will get to that next part in just a second, but first, our third and final poll question for those who joined us late. Please jump in and answer this one. It's a fun little add-on to this, and it is: when was the last time your plan had an investment change? Was it less than 1 year, 1 year, 2 years, or 3+ years? I can only answer the trust companies because I'm in this every day and see it every day. But Adam, do you have a good guess at this one?
You know, it's I'm sure it's going to be all across the board, but yeah, I'd say most plans probably make changes every 1 to 2 years. But I'm curious to see what the audience is going to say.
Yeah, well, if they are plan sponsors, then they've had to send out all the communications around what those changes were, so I'm sure they'll have good answers. Otherwise, it's maybe a bit of a guess. And we'll give it just 1 second and let that close, and then jump into our final part of the presentation. And there you go. The majority say less than 1 year. That's good. Assuming that holds true, I think that means that whoever's advising you, be it trust company or somebody else, is doing the work behind this and making tactical changes along the way. So that is great. And we will jump into some investment changes that we're looking at here. And again, if you're not a client of ours, just obviously this is a chance for you to talk to your current advisor or record keeper, whoever it might be, about what they're looking into and understand what's coming around the bend for you. So the first part of this is the role of rebalancing. We are very big on rebalancing. I think this portfolio will show why, and perhaps a couple of stories around it. But Miranda, do you want to talk to us about these two different sections?
Sure, and I won't spend a lot of time on this, but even if we made no changes to our allocation in our models, we do encourage rebalancing, and we do rebalance once a year or even more than that. And that's really as a risk mitigation level. So if you need to be at 50% bonds and 50% stocks to manage your risk, and that meets your required return, it's our job to keep you there, right, pretty consistently. And so if a portfolio that starts out that way is not rebalanced back to target, back to that 50-50 or whatever it might be, 60-40, 70-30, stocks outperform bonds over time. And that's just the way it goes. They have a higher return, and so they become a higher and higher level of the portfolio. And so we really think of rebalancing as a risk mitigation way to do that.
Yeah, and if you look on the right side of this, right, so this is the portfolio that's never been rebalanced over 30 years, and it's clear that stocks have outperformed bonds over a 30-year period, right? And so that's why you see stocks leaning much, much heavier there. And so outperformance, great, super, you picked up on that. But let's see, it was during the bear market of 2020 and eventual recession of 2020, a couple of years ago. I talked to a client who had been rebalanced every year, and he was pretty close to that 50-50 mix. And he said something that was pretty interesting. He said, I've been through a lot of these different cycles throughout my career, but never one when I'm thinking about retiring. And when we were able to tell him that he was down a very small percent compared to the 31% that the S&P was down at the time, you could just see the comfort, that he had with that. And so staying within that risk level the whole way along really suited him, right? It may be return-wise, who knows, but it suited him, and it was there for the right time when he was most nervous about it. So again, that's just sort of knowing the participants, spending time with them, and being sure they are invested the way that they should be based on their risk tolerance. RPS model changes. We have a couple changes here we're going to talk about. Miranda, do you want to start with this?
Yes. So these are the changes we made this year, and I will say that we don't make changes just to make changes. And even if we don't make a lot of changes, we still spend the same amount of time looking at it and thinking about, does the current allocation make sense? This year, we did make some changes. We took a little bit out of small cap and a little bit out of international developed and put that into large cap US. And both of these asset classes, small cap and international, have higher expected returns over the next 10-year period than we think the US will. However, going back to our risk management philosophy, they also have much higher expected risk. And so that's why we thought it was prudent to trim from them and put it in the US large cap market, and still get to a rate of return that we thought was reasonable. So those are the main changes we made on the growth side, is just really around trimming the risk and looking at the risk metrics there. And then on the fixed income side, we decided to change managers. And so this will be happening sometime this year on the RPS side, but we had the PIMCO foreign bond fund, which was a fine fund. But in this environment with low and expected to rise interest rates and inflation, we really wanted a manager who was more active, who was able to, throughout the year, take advantage of what was going on in the markets, be a little more nimble, allocate to different types of fixed income instruments and in different places in the world. And so that's why we made the change to the global bond manager, and also took a little bit out of core bonds. And so it's no surprise that analysts are expecting core bonds to not do so well in the US this year. In fact, in January, bonds went down as interest rates went up. And so we like to build a really diversified fixed income portfolio to help our fixed income investors against specific risks in the fixed income side, like inflation, like rising interest rates. So we don't want to take a ton of risk in this part of the portfolio because we still believe it's the ballast, but we also want to be prudent with the decisions that we make here. And so that is why we have an 8% allocation to that global total return fund, which we think can help mitigate some of the things going on with the Fed and the US and interest rates, and just take advantage of what's going on in other places in the world.
Adam, I think I told this story on one of these webinars before, but my wife started a new job last year, and she sent the 401k email over to me and said, "What do I do?" And so I printed off the list of holdings, and I counted there were 77 total holdings on the plan. I work in this industry, and I was exhausted at just the thought of like trying to figure this out and navigate and what's the best. And here we're looking at what, I don't know, 13 to 15 total funds. So what's the right number here? I mean, what's the right approach for plan sponsors?
Well, I can tell you the right number is not 77. But when we're thinking about creating an investment lineup, what we don't want to have happen is paralysis by analysis. So essentially, there's too many investment options, and so people shut down. So I'm not sure that there's necessarily a right number, but I think anytime you get above 20 or 30 different options, that's when you start encountering too much. There was actually a really good study done by an Ivy League school a few years ago, how much choice is too much choice. And so they pegged that number, right around that 20-30 mark, and said once you get above that level, participation can actually drop in retirement plans. And I think that's due to that paralysis of analysis. So Zach, your wife, if she was looking at 70 different options, she's probably going to say, hey, I don't have time for that right now. I'm just not going to do anything. And so at the trust company, when we're creating our lineups, we definitely want sufficient diversification. Participants should always control how they're invested. They should have plenty of choice, whether that be US or international, stocks or bonds, large cap, small cap, value, growth. You want to have the sufficient choice to carry out your investment objectives, but you don't want so many that it becomes overwhelming and participants just shut down. So we think the 14 funds we have here does give that choice, but also keeps it narrow enough so that participants have an easier time making their decisions.
Yeah, and what I love about what you and Miranda and the team have done here with this lineup goes back to what Miranda said earlier about active versus passive. And so some of these, again, my wife's, but also many others that I look at that we're exploring with, a lot of them don't select for you, the participant, right? They're giving you options between US large cap active or this Vanguard S&P 500 index. So that they're sort of making you choose which route to go versus the experts, the advisor saying, this is the way you should go based on our knowledge and our research. And so that's one of the parts I like about this too, is slimming down the options while giving them clear direction. So that's been a benefit as well.
And one other
Miranda,
thing,
we talked a little bit about this. Do we need to I'm sorry.
Oh, I think there might be a delay in our mics, but one other thing I'd add on that previous slide is just offering participants different ways to invest. So of course here, you can see the 14 different funds we offer as standalone options, but sometimes participants don't even want to research that much. So there's also risk-based portfolios. We have our growth and fixed income portfolio listed here. So those are prepackaged solutions that participants can say, I know I want to be aggressive. Let me pick this growth portfolio. I know I want to be conservative. Let me pick this fixed income portfolio. Or you could have any combination of the two, whether that's 60% growth, 40% bonds, higher, lower, and then of course the target date funds that automatically get more conservative as participants get closer to retirement. So having different ways to invest is good beyond just different types of investments as well.
Yeah, you're right. And having something like those target date funds as a default option is beneficial to participants too, because many people just say, give me the base strategy and let me go back to my job. So, that's a good benefit to have as well. Miranda, do we need to cover this a little bit more? I know that you just talked about this a little bit in terms of the change that we've made on the fixed income side.
Yeah, I don't have a lot more to say about this, but we do take fund changes pretty seriously. We don't make changes just to make changes, but we are putting all of the managers through the same process, whether we made a change or not. All of the managers in that lineup went through the same process, making sure we do have the best managers in each slot. And this year, this is just the change that we decided to make.
There we go. And we will wrap up with maybe a question here in just a minute, but also talk through a summary, which does not appear to be loading on my screen. Are you all able to see that right now?
Not currently. I just see the title.
Okay. Well, let me point these out, or call these out. We got 3 of them here, Miranda. Maybe talk through each one a little bit. The first is that inflation will likely remain elevated in 2022.
Yeah, so that's definitely what we're expecting. And we do have REITs, as mentioned, in our portfolio, which is a real asset, which is a nice hedge against inflation. And so especially with the conflict that we see, we do think that inflation likely will remain elevated.
There you go. And the second one is you're seeing now pop on, talking about return to risk expectations when composing portfolios, excuse me.
Yes, just to reiterate, it's important to consider both sides of the equation when thinking about how to invest.
And
then the third one, yep. And then we follow best practices for the menu for plan investments. And so there are some things that we have in other portfolios that, as Adam mentioned, just aren't appropriate for participants to be able to select 100% of their investments. And so our wealth management and our other lines of business, it's not just a cookie cutter approach. We do tailor it specifically for retirement plans.
Good. And we've got a few questions that came in somewhere around Russia and Ukraine that we were able to address. Another about investing to protect against inflation, which Adam covered. And a third one here that we have, Miranda, that we've not really covered directly is, should I still invest in bonds if rates rise and inflation continues?
So that's a good question. We're getting lots of those questions, and it really depends on what your risk profile is. And so we still believe that bonds are the ballast to the portfolio. And so if you have a short time period, less than 10 years, it probably makes sense to include some fixed income exposure. And we do forecast our expected return for fixed income, and it's not negative, right? So it's going to be higher than cash. But if you have a really long-term horizon, it probably doesn't make sense to load up on fixed income because inflation is not good to fixed income investors, and rising rates that eats away at fixed income return as well. So I would say it depends on your financial plan and financial goals. So it's important to know what those are. But if you have a long-term horizon, I would stick more to growth. And if you have a short-term horizon, it's probably better to see exactly how much fixed income you really need to offset some of the other risk in your portfolio.
So I know I get that question from participants a lot. And, like Miranda said, I think it goes back to what role should bonds or fixed income play in your portfolio? And so as I think of a sports analogy, bonds are really the defense. Growth, asset stocks are really the offense. And so if you're thinking about bonds playing defense, their goal is not really to be return seeking. You're not trying to earn 10+%, from a bond portfolio. You're really there trying to preserve capital for those expenses that could be coming up in the next, 2 to 5 years, and you don't want to subject to volatility. So even though interest rates could be increasing, inflation is a very real consideration. Remembering the ultimate purpose for that allocation, playing defense, capital preservation, I think is a good way to look at it.
Great points and great presentation. Thank you guys for putting that together and for joining us, especially you, Miranda, as our featured guest this month. And next month is going to be a topic on March 31st, 10 a.m. about record keeper acquisition. is your provider next? For those plan sponsors in the space, you probably already experienced some of this. There's just incredible consolidation going on right now in the record keeping space, and many rumors out there about what's to come. So we'll cover all of that and what to do as the plan sponsor in those situations when they arise. But before I turn this over and we'll turn it off, Miranda, Adam, anything we missed or that you'd like to cover? Good?
Not for
Miranda?
me, but thank you everyone for attending today.
Yeah. And Miranda, thank you for joining us. Yeah, thank you everybody. And we will see you again on March 31st.